Thank you for joining to the earning call of a Crompton Greaves Consumer Electrical Limited. On behalf of Edelweiss Broking, I would like to welcome management team of a Crompton Greaves Consumer Electrical Limited to discuss the result. We have with us Mr. Santanu Khosla, Managing Director of the company, Mr. Matthew Job, Chief Executive Officer, Mr. Sandeep Batra, Chief Financial Officer, and Mr. Yashwant Rege, Vice President Strategy and Financial Planning. I would now request Mr. Khosla for his opening remark, post which we can open the floor for Q&A. Over to you, sir.
Thank you, Praveen. Good morning, everyone, and thank you for dialing into our call for talking about our results of the second quarter. As usual, I'll try and give some color and flavor around the numbers, and then we'll try and keep as much time as we can for any questions you all may have. Let me start by talking about our segments. First, our core ECD segment showed a strong growth of close to 15%. All our key product lines in this segment have shown double-digit growth. The real drivers of ECD were fans, pumps, and also towards the back end of the quarter, geysers. We have, in spite of continuing cost pressure and FX pressure, we have managed through mix and continuing cost reduction programs to not just grow the top line on this segment, but importantly also grow bottom line, improving our margin for the segment by about 100 basis points. This really is a reflection of our key strategies as we are continuing to implement and drive the business behind them. We introduced a lot of new products in fans, especially in the critical 2,000 to 2,500 rupee price segment. Not just Air 360, which we've talked about, but also variants called Senorita, Splits, Digitna. And most of these have shown good initial results. And through this quarter, the growth of this critical segment was 35%, which was one of the prime drivers behind not just the total fan mix, but also the continued improvement in our mix of the fans business. Pumps also continues to perform exceedingly well, especially behind the ongoing initiative of Crest Mini, where we clearly are growing our business faster than competition. The volume was strong. We increased our pumps volume by 25% in the current quarter. Importantly, a key future growth area of agricultural pumps, which we've been driving for some time, trying to get deeper in our distribution and marketing, etc., grew by about 70%. We see this as a critical segment, and we see this looking forward to continue to be a critical growth contributor along with fans. Geysers also we've talked about in the past, but really now this is the season where we plan to really drive geysers. We have revamped our entire range of geysers and upgraded it across the board, instant as well as storage, introducing a number of new items like Jenna, Solarium Neo, Amica, etc., with a strong focus on both performance and also importantly product aesthetics. We began to obviously roll this out in the back end of this quarter, and initial growth has been strong, but clearly it is going to be one of our key drivers as we go into the critical winter season for geysers in the next quarter onwards. So that's ECD, and ECD we think is performing strongly. We see it continuing to have potential for growth. We think our strategies of driving better distribution, driving better visibility in store, driving cost and innovation are all now consistently delivering results top and bottom line. Let me move on to our other segment, which represents about 25+% of our business, lighting. Now, lighting is, without a doubt, it's been a challenging period, as we've been talking about for some time. The story of lighting is very, in some ways, simple, in other ways, complicated. Our volumes behind our LED program continue to grow nicely. Our volume growth on batons and panels is in excess of 20%, and our lamp volume growth is also in excess of 20% ex ESL. In fact, LED lighting, even in value, ex ESL grew 14%. The challenge is that price erosion is continuing, and at the same time, and we estimate that over this period the price erosion was something in excess of 10 to 12%. And at the same time, while we're continuing to have price erosion, we are also facing significant cost challenges, especially due to the foreign exchange headwinds. Since a significant amount of everyone across the industry, the LED cost is dollar-based. What this is resulting in is, while we're continuing to grow volume across the board, we're continuing to grow distribution, it is resulting in, obviously, the value due to the price erosion not growing, and also the margins getting impacted. For us, it is clear that lighting is strategic, and we will continue to drive the lighting business with a combination of distribution, advertising, and also product innovation. We now have a program to recover margin in spite of the headwinds we are facing. We have a very clear program to recover 400 to 500 basis points of margin via cost reduction. This program is already in place, and it has a number of legs. Leg number one is we are continuing to look at optimizing our design of key components, things like drivers, etc. This has been one of the elements which have helped us in cost reduction in the past. We are continuing to do that. The second, from a pure sourcing point, we are looking to source components directly from suppliers in China as opposed to only going through aggregators. Thirdly, we're using technology in purchase significantly by moving more and more of our purchases to e-auctions, which are also delivering savings. Finally, we are also in the process of moving more and more of our LED production in-house in our own factories. We have already moved a reasonable amount of bulbs. By Q4, we would have moved the majority of our bulbs to in-house. From September onwards, we are beginning to produce streetlights also in-house. And by Q3 and Q4, we'll have stepped up the in-house production of patterns and panels. So all these programs together, which we have defined well, because we recognize how important it is to keep driving cost and bring back margins somewhere around the double-digit range, we expect to be going in as we speak. They will obviously gradually ramp up, and we are aiming to restore our margins back over the next 2 quarters on lighting. While we are doing this, we are going to continue to focus on what has worked to deliver all this great growth in lighting. Distribution is key. Advertising is going to be key. We are also introducing more premium value-added items. For example, we introduced a 5-star LED bulb in the beginning of this quarter called Leor, which is a totally redesigned bulb in terms of shape and packaging, apart from being 5-star, and we're selling it at about a premium of 20 to 25% versus the base product. So this continued introduction of premium initiatives over the next quarters will also help the top-line growth. So net on lighting, we believe that we still have huge opportunity for growth, and we will keep driving these opportunities for growth. We now have to accelerate the execution of our identified cost reduction programs over the next 2 quarters to get our margin back to what we believe is the right margin for lighting, which is about double digits. So with that, I'd just like to now sort of toss it over to you folks for for questions with a final summation sort of my comment saying ECD is actually growing for us broadly. Margins continue to be healthy and on the growing end. Lighting, we do face price erosion and cost challenges, but we're confident that we have plans to address this erosion over the next 2 quarters. We expect that price erosion will reduce but not disappear. We think that price erosion will kind of stabilize on the bulb business, but it's difficult to predict, but we are planning, assuming that some price erosion continues on other segments of the lighting business. So thank you, and I'll now just toss it over for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. I would like to remind all participants to please limit your question to 1 per participant. You may come back in the question queue for your follow-up. We would take the first question from the line of Renu Baid from IIFL. Please go ahead.
Yeah, good morning, sir, and thank you for the opportunity. My question is just to understand a little more on the margin profile. For this quarter, if we see on a sequential basis, lighting and ECD margins haven't actually compressed as much at the EBIT level. But on the gross margin, the decline has been substantial. Few reasons they've already elaborated. So how should we look at the company-wide gross margins moving ahead, assuming the lighting is expected to be back to double-digit levels in the next 2 to 3 quarters? Can we expect the gross margins to be back at the previous level? And also, if you can just mention the reasons for decline in the analog cables this quarter. Thanks.
Decline in the? Analog cables.
Analog cable expense.
Okay. First, overall gross margin, and let me start with ECD. I think one thing to keep in mind is historically our margin profile always improves in the summer season months.
Right.
Due to the seasonality factor where the volumes of the higher margin products such as fans is more. So a better comparison on margin progress is to look on margin progress versus same period year ago. Second thing to keep in mind is on ECD again, since we talked a lot of lighting. On ECD, while we have got strong overall value growth, volume growth is ahead of value growth. And one of the reasons for this is that we are getting disproportionate growth from the Crest Mini initiative, which we're extremely happy with. So while that may have some downward pressure on gross margin, we think that it is strong. It's a strong driver of overall top-line growth and overall profit growth. On the last thing, I'll just let Sandeep take that.
Hi, Renu. Good morning.
Yeah.
If you see the analog cable costs, they are largely in line with what was there in the immediately preceding quarter. So 26 crores, it is 24.5 crores, 25 crores. But compared to the same quarter last year, that's largely because of the reduction in the ESOP charge.
Okay.
That fits in analog cable expenses.
Sure. Thank you so much and all the best, sir.
Thank you. Next question is from the line of Venugopal Gare from Bernstein. Please go ahead.
Hi, thanks a lot for the opportunity. Just one question. In this quarter at lighting, as well as the first half, was there any EESL business? And more so, how is the order book incrementally developing on the EESL side? And also want to understand that, is EESL, as I understand, it will be probably lower than what it was last year. So does that also have a role to play in the margins and how that is varying? Because with lower ESL, it seems like the margins have fallen.
Yeah.
ESL higher margins.
The ESL, in the quarter, the ESL business has been significantly lower than the same period last year. If I look at LED, the LED fixtures, there has been almost a 35% drop in the ESL value compared to the same period last year. And in bulk, it was basically about 10% down. So I think overall ESL has come down. If you consider the LED business without ESL, LED business without ESL is grown 14%. So I think and going forward, you asked also about the order book for ESL. The order book for ESL end of September is around 35 crores.
Okay. There's just one more thing I'd like to mention about ESL, especially looking forward, and this is partly, of course, based on public comments made by ESL. The ESL business, we've got to remember, really consists of two parts. Part number one has been what has been the largest part of this business up till now, which is simple bulbs. Now, as ESL has declared, this bulb business, they have basically done their job, and now they are going to gradually get out of. However, there's a second segment, which is a street light segment, which historically ESL were not involved in, and this business was done directly with various municipalities or localities or governments. Now, ESL, a lot of these are getting aggregated through ESL. So in a sense, ESL has sort of become the central purchase operation to supply street lights to not all, but quite a few of these. So this, in a sense, the street light is sort of a new business for ESL, and this is gradually developing, and if I read what ESL has said in public, this is their focus area for lighting in the future.
Thank you so much, sir.
Thank you. We take the next question from the line of Venkatesh from Citigroup. Please go ahead.
Yeah, good afternoon, sir. The question is something like this. It's a broader strategic level question. You mentioned that your value growth was lower than your volume growth in the ECD segment. And it is also reflective in the fact that...
Sorry, I'm sorry to interrupt. Not in the ECD segment. In fans, for example, the value growth was ahead of volume growth because we were driving the more premium end of the market like we've been driving. Only in pumps, where for the last about 6 quarters, we have really been driving the Crest Mini, which is at a lower price point, is the volume growth higher than mix growth. So when you bring ECD together, we have positive mix. And I do believe this pumps, because if you recall, about 3 to 4 quarters ago, we were facing competitive challenges with pumps, and then we brought in Crest Mini, and the good news is not only is Crest Mini growing, but other segments also growing, and today just looking at, the last couple of quarters of pump competitor reports, our top line and bottom line on pumps is actually growing faster than at least all the numbers I have seen up till now.
Okay. Sir, so let me rephrase my question. Now, in pumps, for example, the value growth has been lesser than the volume growth. Similarly, on the lighting, you mentioned a similar thing happening. Now, especially focusing on lighting, when we talk to people in the channel, the response which we are getting is there was initially a price cut which happened through 2 new entrants, India Bulls LED and Jaguar. And actually, there were only a few people who reacted. Maybe Cisca reacted, but among the top 3-4 players, it was basically Crompton who is leading the price fall in lighting. So is there a conscious strategy by the management that you are actually cutting prices to grab market share in the current environment? Because we don't see a similar thing happening with Havells' numbers. Their margins doesn't seem to be getting impacted. And neither are they telling that they are cutting prices. So is this a specific strategy from your side that you're cutting prices to grab market share in lighting? And the second, if you could just tell us what are the advertising spends in the first quarter and the second quarter of the current year?
So I think, you're right. I think especially in the trade, in lighting, especially the B2C segment, there has been significant price erosion, and that's, you're right, it was led by two new entrants to start with, and of course, companies like Cisco and many others reacted. I think definitely we have a very clear pricing policy, which is basically benchmarked with some lead competitors, a basket of competitors, and based on the price moves we have observed, we have of course also acted to ensure that we protect our share. And I think, we need to keep, when we compare the margin movements of competitors, I think you also need to keep in mind the LED, non-LED portion of the overall lighting mix. I think one of the other issues we have been facing is because the non-LED lighting business has been going down, has been declining both in terms of top line and bottom line much faster in the last couple of quarters than in the period before that. So depending on the mix of LED and non-LED, you will see some differences between competitors. In terms of pricing, we have in terms of price setting versus key competitors, it is unmoved since the last 3 quarters. And in fact, starting October, we have actually increased the prices of LED bulbs. And again, some of the competitors also have responded similarly. So I think our pricing policy remains consistent, and we'll continue to execute the pricing policy that we have set in place.
Yeah, and to be absolutely clear, in the current period, we did not initiate any price reduction. It was purely a response, and it was not just a response to small new players. It was a response when large players also started dropping their price.
Okay. Sir, if you could just give us the advertising cost for the first quarter and the second quarter.
It's about 25 crores across the quarters.
Sir, could you give the split between the 2 quarters?
Most of it was in the first quarter.
125 crores.
No, 25. Of which
25 crores.
Bulk of it was in the first quarter. That is purely linked to seasonality.
Okay. Thank you, sir.
Thank you. Next question is from the line of Adnam Mitra from Credit Suisse. Please go ahead.
Yeah, hi. Thanks for taking my question. Question was on the GTM change agenda that you have. So you had an adverse effect last year in the second half when you were starting to roll it out. You've given the layout of the next couple of years on this, but I just wanted to get a sense of when do you think the adverse effect of the rollout stops happening, and when does the positive effect of the incremental distribution start coming in over the next year or so?
Okay. Like we've talked in the past, we are not doing this all at one go across the country. It's in stages. And it's really focused on creating stable prices, creating good coverage, and regular beat work by salesmen. So as you can see from if you just look at our ECD business, and if you track the growth of our ECD business over the last 4 or 5 quarters, ignoring or adjusting for last quarter's growth, because last quarter's growth was obviously high because of the GST base being low, you will see a continuing increase in the growth rates quarter on quarter. So it's actually beginning to deliver on an aggregate India basis. It is continuing to deliver results. If I go back, we were growing the ECD business about 9-10%.
Yeah.
Then it went up to about 11-12%. And now this quarter is 15%. Again, I'm not counting the 25% of the GST quarter because that's obviously an adjusted number. So there's already a steady. Now, that is not only because of GTM. GTM, the better distribution is one of the enablers, but it's also the product it's the innovation, etc.
Sure. Thanks. That's it from my side.
Thank you. Next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, Shantanu. Morning. My first question is, you talked about, insourcing some of the products, if I heard you correctly, in the lighting part. So, insourcing, and as well as you said that I might change the procurement directly from the vendor sitting abroad rather than, you must be giving some business to aggregators here who are the EMS companies. So, is there a change that we largely will take everything from abroad on our supply chain and we will just remove the middlemen or the, let's say, the EMS company from here?
Not obviously everything at one go. But it's a gradual shift because we also have to make sure that it's not just a matter of price. We have to make sure that the quality, the reliability, etc. It's a gradual shift over time. And as we're doing that, we are obviously want to make sure reliability and quality, if anything, keeps improving. But you're seeing cost benefits as you move this change. The second thing is, like I said, on this whole area, we're seeing e-auctions are beginning to kick in and they are working well for us. And the final thing is, which is also a gradual change over the next couple of quarters, is in-housing. So we're gradually bringing in more and more of the final lighting manufacturer into our own plant. And we're seeing that, again, have three benefits: better reliability, better quality, and we are getting cost benefit. So the cost benefits of all these things is what is adding up to our plan to get back the 400, 500 bips on margin.
Possible to quantify how much in the lighting business you outsource to a company like, there are EMS companies like Dixon and all, or big in lighting, which can we get insourced by you? Is it possible to share?
I can tell you, for example, in LED bulbs, about a year back, we may have been 80% outsourced. By the end, I think in the current quarter, we would be less than 10% outsourced in LED bulbs. Panels and panels, we were completely outsourced till September. But now I think in this quarter, almost 25% would come in-house. And similarly, there is also a move in street lights. So over time, of course, a bigger percentage of our overall sales will be from in-house production.
Thank you very much. Thank you.
Thank you. We would take the next question from the line of Ankur Sharma from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi sir, good morning and thanks for the opportunity.
Morning, Ankur.
Hi. Sir, so my question was on the lighting segment. Now, if I remember my numbers correctly, close to about 70 to 80% of lighting is LED. And within that, again, upwards of 60-70% is fixtures, right? Now, and the other way to also look at the lighting segment is that close to about 50% is B2B. Now, my question really is that is this price erosion across fixtures and also on the B2B side? Because my guess would be it should be more on the B2C side, right? So what's really driving this very sharp margin erosion? Is this that even in fixtures, even in B2B, you seeing a similar price erosion?
Yes, it's across the board. If you go back 2 years when the whole LED growth program sort of started, both with us and then industry, at first the price erosion, at that time driven by cost, first started on bulbs, then it moved to panels and battens, and now it's very much there in B2B. In fact, as I was mentioning in my opening remarks, we think that price erosion is now not going to happen much on the bulbs. In fact, a couple of leading companies, including Philips and us, have announced some price increases in bulbs, but we think there's still possibility of erosion to happen in the other segments.
Understood. Great.
Also, I'd just like to, put this in context because, we tend to look at quarter to quarter, which is absolutely right. If you recall, if we go back 2 years ago and you look at our numbers, we were small But it's not that we made high margins. We were only about a 4-5% margin. And then gradually as we build scale, moving to this number 2 position in terms of total size, we also managed to build margin to a peak of about 10 to 12. Then, over the last 2 quarters, price erosion happened even more. And frankly, even last quarter, our lighting margin had come down to about 6.5. A little higher, but not too different from what it is this quarter. Now, we need to build it back up to that 10%, and the only way is cost.
Sure. Got that. Great. Thanks. That's all. Thank you, sir.
Thank you.
Thank you. Next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Hello, sir.
Good morning.
Good morning, sir. So you have talked about this price increases, in the LED side. If you can just quantify like how much price increase we have taken, what could have been the absorption in the market, and in any other categories, have we taken any price hikes?
We have effected some price increases from October, only in LED bulbs to start with, roughly 3%. That's what we have done so far. And some, as Chandru mentioned also, a couple of our competitors also have announced price increases, and I think that's going to happen also because there is significant, product-related cost pressure. So that we expect that this trend will continue. So more of the competitors would announce price increases, and then the volumes would, and we have not seen any negative response to the price increase we have taken so far.
Okay. And any other categories, so we have taken any price hikes?
Oh, yes. That's an ongoing process, and it tends to be a couple of points because the reality is that commodity costs and foreign exchange costs affects everything, maybe lighting proportionately more, but that's part, as we've always said, we will grow our value higher than our volume, and we will cover the cost increases with a little bit of pricing, a little bit of mix, and a little bit of cost reduction projects. And that is what has been playing out in most of our business for quite some time and continues to play out in ECD. It is simply that in lighting, in this near term, that incremental costs and the pricing at the same time was, for the point in time, creating this extreme volatility. Because even if you just think of, for example, Forex, now, and this is not just for us, but in the industry, LED has about a 35-ish percent, 35 to 40% imported component, dollar-based. And the dollar has gone from 65 to 75. So that's a real cost everyone has to cover. And ultimately, it's done by reducing other costs and some pricing.
Okay. And sir, another trend is like we are hearing, more and more insourcing now, in the LED side we are doing. So in the other categories also, do you see that this, insourcing trend can pick up? And as, maybe for example, in fans, we need to have, more control on the, the paint shops or something. So if you can just give more, this insourcing versus outsourcing, how we balance out in the longer term. That's all from my side.
We're in the process of doing a more long-term study on which we'll take some basic decisions and obviously share them at appropriate time. But up till now, we've not taken any decision. Lighting, you must remember out of all our categories, over the last 2 years, lighting has been the most dynamic. It has grown the fastest, products have changed the fastest. Not long ago, a bulb cost 300 rupees, now it costs 70 rupees for the consumer to buy. So in lighting, yes, insourcing brings us cost benefit, but that is not the primary driver for lighting insourcing. The primary driver is really to improve quality and customer service. The second thing you got to realize in lighting is we already had the asset because we were making non-LED traditional CFL lights. So it's also a matter of, in the case of lighting, the asset utilization, because we're not having to build new factories. We're really just replacing CFL capacity with LED capacity.
Okay, sir. Thank you, sir. That's all from my side.
Thank you.
Thank you. Next question is from the line of Kunal Sheth from B&K Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, my question is regarding the fan segment. Sir, over the last few quarters, we've been focusing on the mass premium segment, that is the 2,000 to 2,500 rupee range. So what would be the share of that segment in the overall fan sales right now for us, sir?
Okay, we'll just have to check the specific number 1 second and get back, right? But this is the key one. While they're checking the number, let me tell you that this segment is significantly larger than the 2,500 plus segment, right? Just the way the pyramid is. The other one is, just so you, I don't think I mentioned this in my opening comments, but the other thing which is happening on fans is one big chunk of growth is coming from 2,000 to 2,500 where most of the new products are. But we are also seeing a lot of growth due to our investment in driving deeper distribution in the sub-eco and eco segment, which is also grown this quarter in excess of 20%. Right? So it's really about new products, innovation, advertising at this mass premium, and driving deeper distribution at the bottom of the market.
Sure. And sir, what would be market share for fans right now?
Market share for fans, if you look at it retail audit-wise, about 25 to 26, somewhere in that range. So we continue to creep up market share. Admittedly, we're not growing market share as fast as we were growing 18 months ago. But we estimate that the market is growing maybe at about 6 to 7% on a steady-state basis. And so it also tallies. So we're growing up market share, but not as fast as we were.
Sure, sir. Thank you so much.
Thank you. Next question is from the line of Nilesh Bhaiya from Macquarie. Please go ahead.
Hi, this is Indrajit here. Thanks for the opportunity. My question is on this new categories, especially the water heaters that you mentioned, that various products have been launched. Can you just talk about what kind of impact do you think it will make in the first year, and what kind of aspirations we have, how quickly we can get to, say, a credible number 3, number 4 player, and it translates into what kind of revenue size?
I think, the range of geysers which we used to sell was, was something which was launched many, many years ago. So I think so that is one. Second, there were some specific product gaps, especially in the 5-star entry-level segment we had no offering. So what we have done so far is revamp the entire range and fill the gap. So the product we spoke about, Amica, Gemma, Solarium Neo, is basically one, a refresh of the existing range, and second, filling a critical gap, which is a 5-star entry-level range. We have launched this towards the tail end of the last quarter, and some are still being introduced in the current quarter. So while we grew our geyser business by roughly 20% in the last quarter, we hope that with the introduction of these new ranges, we will continue to have strong growth in the quarters ahead. In terms of the time frame to reach a number 2, number 3 is very difficult to predict, but the market of electrical water heaters is roughly 2,000, 2,500 crores. So I think there is, even with a 10-12% share, I think there is still a significant upside for us, in the next few quarters.
So if it succeeds, and I guess we don't want to talk about it too much because this winter is really the first critical winter, and we can talk much more about it with more data in our next quarter call. But if this program works, it will not be insignificant.
Okay. Just one kind of extension of that. In every category, we have talked about bringing in a differentiated product. So is there that kind of a flagship differentiated product in the geyser segment that we have launched or about to be launched?
In the geyser segment, as I mentioned, we have 3 things we wanted to do in the short term. One, a complete range refresh, because our existing range was dated. It was many, many years old. So a refresh of the existing range was number one. Number two is to plug the biggest gap that we had, which is entry-level 5-star. That is what we have done so far in the last quarter and continue to do in the current month. Going forward, of course, is to create a differentiated offering, which is also in progress. The exact timing of which, we cannot mention for obvious reasons, but that's also something which is in the works.
So the idea of having a flagship differentiated product is a key element of the strategy.
Thank you.
Thank you. Next question is from the line of Praveen Sai from Edelweiss. Please go ahead.
Yeah, hi, sir.
Good morning.
Sir, in the ECD business, we had given a good growth, but if I look at the other competition, they had given a far superior sales growth as compared to us. So can you give some sense, like, from where they are getting really as strong as compared to us?
I think better to ask them, and I guess you are not talking about anyone else apart from Havells, right? Because V-Guard, for example, we just saw the numbers and their growth was significantly lower than ours. Kirloskar in pumps was also significantly lower, and I've not seen any other numbers. But how they are, because you probably have more information than me. I can only relate to what they talked about in their public comments, where one of the comments they made was to do with the fact that it was off a lower base of the previous year, which frankly, obviously, I have no understanding or details. All I can say is our business is growing, continuing to grow at an accelerating rate over time in quarters. Do we have opportunities to drive even more growth by segment, by geography? Of course we have, and we're continuing to work that.
Okay. Even in the last 4 quarters, not this quarter, even in the last 4 quarters, I checked this number. So we'll discuss detail in the offline, I suppose, sir. Sir, one more question. Can you give some, capex plan for a 19 and 20?
So our capex, while we are looking at, initiatives like what more could we make in-house, overall capex for both the years, for this year and next year, will be all around 25-30 crores.
Okay. Thank you, sir.
Thank you. Next question is from the line of Rahul Ranade from Goldman Sachs. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Just another question on the GTM. So wanted to get a sense of the, degree of progress on that and what kind of disruption are you seeing in the business, if any?
Okay. Like I said, if I look at it on a national basis, and if I keep out lighting, because I believe the challenges in lighting right now have really got nothing to do with distribution, etc. And I look at ECD, if our growth trends are continuing to accelerate over time. So on an aggregate national basis, it's difficult we're managing it in a way so there is no big disruption nationally. Like I said earlier, this is executed town by town, literally. And in a particular town where you try and bring in price stability, etc., for that town, typically it is about a 2 to 3 month period before we see business picking up. We saw that when we first did lighting in the south, and we continue to see that is roughly the amount of time it takes. But like we've always said, we're managing this pragmatically. We're managing it so that we continue to build our direct dealer business while we add on stronger distribution business. And on a national basis, as long as our growth continues to accelerate, we think that it is being managed fine.
Sure. So right now, I think we first started with the western part of the country and now have ventured into the north. So I kind of remember you saying that in the last call that, North is more wholesale dominated and could be a little bit of a challenge vis-a-vis the West. So
again, we're seeing progress in the North, and again, North also then splits up. For example, in Delhi and NCR, which is a little more developed, we're seeing much more growth coming back quicker. By the time you get to areas of Eastern UP, which are more slum, it takes a little more time. So it varies, but the general principle we're seeing holding true, which is in a particular town, when you begin to make the changes, you start seeing the positives in that town after about 3 months on an average.
Okay. And are new products, like suppose for geysers, are they introduced directly in the new kind of a distribution network, or is it kind of then...
Again, I just want to clarify, right? We always had dealers. Some of the dealers were retailers, some of them were wholesalers, and some of them were distributors. We are continuing to work with the wholesalers and large retailers.
Okay.
What we are doing is, the people who are distributors, we are improving their distribution capability. We're making sure they've got more salesmen who are better trained. We're making sure that they're using data to make their choices. We're making sure they're rigorous beat plans. So, obviously, when we do anything, be it geysers or a new fan initiative, it goes to everyone. Because each of these channels plays a different role.
Sure. Got it. Yeah.
Thank you. Before we take the next question, I would like to remind all participants again, please limit your question to one per participant only, as we have people waiting for their turn. We will take the next question from the line of Ashish Jain from Morgan Stanley. Please go ahead.
Hi, sir. Good morning. So my question pertains to the fixture business within lighting. Correct me if I'm wrong. I think fixture accounts for roughly 60% of our lighting revenues. So what are the trends we are seeing on that front, both from cost and more importantly from pricing perspective?
I think, of course, fixtures are the bigger part of the lighting business. Again, the volume growth have been very strong in LED fixtures, both in B2C and B2B, which is in B2C is primarily battens and panels, and B2B pretty much everything. But as Shantanu mentioned already, the kind of cost pressures which we found, and the pricing pressures are there in fixtures as well. In fact, it is only in LED bulbs where we feel the pricing pressure has abated in both the B2C. Yeah. For example, the patterns which used to sell at 400 rupees about a year and a half back is now down to 200 rupees or even lower. Street lighting prices have crashed by almost 25% over the last 1 year. So I think the pricing pressure continues in fixtures, and we think it will continue for some more time. Only in bulbs we have seen that pressure has abated actually.
Okay. Got it, sir. Thank you so much.
Yeah.
Thank you. Next question is from the line of Abhineet Anand from SBI Cap Securities. Please go ahead.
Yeah, thanks for the opportunity. Just wanted to know what has been the fan growth in terms of value and volume for 1H or quarter, whatever is possible.
Okay. Again, we don't give exact numbers for our subcategories, but let me say that our fans have been a key part of the total ECD growth. And number two, fans have delivered a positive mix. Value growth is ahead of volume growth.
Okay, but you did mention that within the 2,000 to 2,500 range, the growth was, if I'm not wrong, 30% plus, right?
Yeah, that's right.
Okay, and if you say that the market in fans have grown by 6 to 7% and we have gained market share, so at least 200-300 basis point higher than that we would have grown. Is it a fair assessment?
I would not make that math, right, because market share, especially if you look at retail share, tends to be, flatter and more long-term. So I would be wary of saying 200 basis points or 300 basis points, but just leave it at, we are growing share. we are not growing share as fast as we were 18 months ago when we just introduced anti-dusk and we for the first time started driving premium.
Okay, thanks a lot, sir.
Thank you. Next question is from the line of Anshuman Deb from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. I want to understand about the agri-pump business. You said that they have also shown signs of improvement. And if you could share some numbers on agri-pump, that would be great.
50% plus growth.
Agri-pump. I think agri-pump...
50% growth.
Value or volume?
Value.
Agri-pumps for this quarter had about a 60% value growth.
Okay.
It's still a smaller segment of ours, but like we've always said, it's an important segment for the future because that's the shared development opportunity. And a lot of our key competition in pumps actually has a bigger business in agri. And I think at least, I mean, this is my own hypothesis, as I'm looking at some of the pump competitor numbers, I think what seems to be happening is we are winning in the agri segment, and that's reflecting in both our higher growth and the fact that their growth tends to be lower than ours, but that's just my hypothesis.
Yes, that's very helpful, sir. And another question I had was, you mentioned our fan share of around 25 to 26%. If I am not wrong, it used to be around 27%. So we are gaining market share, right?
Yes, we are gaining market share. And the reason you might have the different numbers was because in the past, when we used to quote share, we used to quote company primary sales divided by industry number. But on fans, at least now we talk about the retail audit share. So it's actually the consumption share coming from a retail audit third-party vendor.
Oh, thank you, sir.
Thank you. Next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Thank you for the opportunity, sir. Just wanted clarification. You had mentioned at the start that the new products in fan segment grew by 35%, or was the share of the new product segment was 35%?
No. Just to clarify, there is this key, let me call it mass premium segment, which is really a segment which is priced between 1,900 and 2,500.
Okay.
This segment in total was where we had introduced a number of new products, including N360. This segment for the quarter grew at 35%.
Okay. Sir, during the last meeting, you had mentioned that you are planning to launch few more products in the H2. So are we on track in the fan segment for that? Or are we...
Yes. Because as we move in, and again, that's a normal part of continuing to deliver on fans. As you move into the season, because obviously H2 is a critical part of fans, that is when we start ramping up our fans, marketing support, the advertising, the new product introductions in different segments.
So generally, sir, what has been the trend of new product as a percentage of revenue for you over, let's say, this year or last year, if you can mention?
I'd be hesitant to mention that because it all amounts to definition of new product. You mean something which was not sold 12 months ago, 24 months ago, etc. But new items which are coming in, like if I take lighting, for example, nearly everything which we sell today was not sold 12 months ago. If I take pumps, Crest Mini was not sold 12 months ago, and that's a critical driver, plus a number of other ones. So it requires a little context as opposed to just one number.
Okay. Because your trend has been that new product introduction in each of the category has been in the range of 25 to 35% between the categories that you have. So that's just wanted to get a sense on that.
Yeah. So our focus obviously is to accelerate that.
Okay, and this last question, could you share your lighting breakup in terms of LED and your fixtures for this quarter?
82% is LED and of course 18% non-LED. Fixtures I think would be Two-thirds. Fixtures is two-thirds of total business, yeah.
Total. Okay, sir. Thank you.
Thank you. Next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, hi sir. I had a follow-up question. So agri pumps is a segment where I think you had started putting some effort a few years back, and initially it had not, delivered the required results. So if you could highlight what were the challenges and what have you changed now, and which is giving this much faster growth in that segment.
Okay. First, I would just like to caution that it is still early days. So I think it's much too early to declare success and say everything is working in agri pumps. Okay? First, the trends are looking good, without a doubt. The two key areas, or let me say three key areas. Area number one was get the right products. Get the right competitive products which meet the need of the agri consumer, because they are slightly different at the right price. Area number two, and this is what has taken us time to work, is where we're going with the program, you need to make sure that you've got a dealer or distributor network which goes deeper. Because the agri pump business is much deeper. It's not a big city business. Right? So it's a dealer, it's a service network, it's everything which you need. That is what it takes a lot of time and investment. Our approach, like I said right in the beginning, was to learn on this by going state by state. And that is how we're continuing to do it, as opposed to trying to do this all at one go nationally. So those are the key things which we've been doing. It's beginning to look positive. But of course, it's early days. So I would not in any way say, okay, we have solved it, everything is perfect.
Right, so there's nothing, dramatically different you have done in the last one quarter to see this 60% kind of growth.
No, there have been some differences, and also importantly what's happening is our ability to actually learn who is the right distributor, which is the right geography, etc. seems to be all coming together, because you need all these three things to sort of work together. Have the product but not the network going deep, there's not much use, and vice versa.
Sure. Okay, thanks. That's from my side.
Thank you. Next question is from the line of Aditya Bhatia from Investor Capital. Please go ahead.
Hi, good morning, sir. Sir, our payables have been going down over the last few quarters. By making quicker payments, are we getting discount from vendors, which in turn is boosting margins to a certain extent?
I mean, our payment, whatever you see, payable value is more in line with the seasonality. But yes, we have used our surplus cash of about what we have, about 200 odd crores, to pay these vendor bills early and get some discount. So that is certainly embedded in the performance.
Understood, sir. And so this quarter, in first half, we have seen borrowings declining, but other financial liabilities have risen sharply. Is it on account of current portion of long-term borrowings which is being shown under other financial liabilities?
That's correct, because we have about 300 crores of debentures which are due for repayment next year, and because that has now become less than 1 year liability, that has been reclassified into the current liability portfolio. That's the reason.
Thank you. Well, ladies and gentlemen, that seems to be the last question for today. I would now like to hand the conference over to the management for their closing comments.
Thank you. As always, appreciate you all dialing in. Our intention is to, as transparently as we can, share everything with you folks. If you have any more questions and any more detail which we weren't able to get to because of lack of time, please feel free. You can contact Yashwant, and we're more than happy to get into as much detail as any one of you may wish to. Thank you and appreciate your support. Thank you so much.